Good afternoon, good morning, good evening, wherever you're watching or listening to us from. You're welcome to Stalker Team, the Investors channel. Before I just go further today, let's just make our usual disclaimer. Every information shared on this channel is for information and education purpose only. So do your due diligence or speak to your financial advisor before making any decision. Another note, we thank everyone for joining us today, watching this episode. On Stalker Team, what we are actually set out to do is to provide investor education, providing the best knowledge that you can bank on, the best knowledge that you can actually trust, that you can also use to do your own due diligence. So we thank you so much for joining us. We thank you for subscribing to our channel, for also joining us on X, at Stalker Team on X, Stalker Team Live on X. So if you haven't subscribed or you haven't joined us on X, so please join. Today we will be continuing on the second part of our ETF edge. So like I said in the last part, the first part of the ETF edge that we did, is that, depending on the kind of investor that you are, whether you are a retail investor or you are an investor that actually like to take on more risk, or you don't mind the volatility, ETFs actually also allow you to tune up or tune down the kind of volatility. And when I mean the volatility, is basically the rate at which your investment or your capital moves up and down in value when you invest in the stock market, in the equities market. So ETF allows you to actually determine the kind of investor you want to be. Do you want to be a more passive investor? Do you want to be an investor that is in between? You are not too passive and you are not necessarily active, but you don't take into a higher risk? Or you're an investor who wants to actually not just be passive, you also want to take on some level of risk, because in investment, there are risks, but when you have that risk, when you have the volatility, the propensity or the probability of your investment to go up and down in value, that is when you actually tend to actually grow your assets, grow the value of your portfolio. So last episode we talked about an ETF that gives you exposure to the broader market, which is the S&P 500. The S&P 500, we talked about that in that episode. This episode we are talking about the index that gives you access to a bit more level or higher level of risk. So this ETF or index gives you access to the top 100 companies, top 100 technology companies quoted on the US stock market, which is the Nasdaq. So in the US we have the New York Stock Exchange and we have the Nasdaq, and we have a few other exchanges, but the two major exchanges are the New York Stock Exchange and the Nasdaq. But the New York Stock Exchange tend to have the big banks, the big multinationals, the conglomerates, the manufacturing companies, and all the corporate companies, the consulting companies, whereas the Nasdaq tend to actually have more of the technology companies, the software companies, the artificial intelligence companies, the companies who are into a whole lot of fewer services but technology related companies. So the Nasdaq 100 is now the top 100 companies quoted on the Nasdaq exchange. And on the Nasdaq you tend to have the likes of Palantir, the likes of Apple, the likes of Nvidia. Most of these companies are really, really grounded in technology. Everything they do is technology. They have very, very limited exposure to manufacturing. Even when they do manufacturing, is technology. So the S&P, the Nasdaq 100 index gives you exposure to the best technology companies in the world, if you may say, quoted on the Nasdaq exchange. So we are looking at that index today, and why, as an investor, you might want to actually consider the Nasdaq 100 index, or the Nasdaq 100 ETF that tracks that index. So come with me. Let's just look into this index. So, just like I said, this is the Nasdaq 100 index. The Nasdaq 100 index is the index that tracks the performance of 100 of the largest non-financial companies listed on the Nasdaq stock market. It was launched on January 31st, 1985, and it is heavily weighted towards the technology sector. The major companies on this index, or quoted on that Nasdaq stock exchange, which now make up the majority of the weighting of the index, includes the likes of Apple, Microsoft, Amazon, Nvidia, and including yours truly stock that I'm heavily invested into, Palantir. So Palantir was on the New York Stock Exchange, but recently it was moved to the Nasdaq Stock Exchange so that it can be added into that index, because it's a major technology company. But talking about the index, so since its creation, the Nasdaq 100 has delivered strong long-term returns. It has significantly outperformed broader indices. It has beaten the S&P 500, quote unquote, blue and black. So it's a very growth oriented, aggressive index in terms of its performance, that it has actually beaten the S&P 500 over time. The index has seen an average annual return of about 15 to 17% over the past few decades, even when it has really seen not too good days, not too good months, or a few years, especially during the dot-com bubble, the 2000 to 2002, and also the 2008 financial crisis. But just listen to this part, what I'm about to say. Over the past 10 years, the Nasdaq 100 has given the best returns, or some of the best returns in history, given the rise in big technology companies like Apple, Microsoft, Nvidia, Amazon, and even Palantir, if you may, especially now that the technology sector is now driven by AI related stocks and companies. So that is a primer, that is an introduction into the Nasdaq 100. And the chart you are seeing in front of you is actually the over the years chart of the Nasdaq 100 index since this index was created. You can see from 1985 up to date. If you look at the all-time performance of this index, it has returned about 16,000%. And the index currently stands as we speak, because the market is actually live, the market is still open. The index is now at 20,203.42. Now we are going to look at this index, at least in the last 5 years. This index has returned an average of about 140%. In the last 1 year, this index has actually managed to do about 11%. However, now, if you look at the last 5 years, let me go back to that chart. Can you see the ups and down? I'm going to mirror in to, let me look at the year. I'm looking at 2000. I want to see 2020. You can see. So if I look at all time, I want to actually mirror on some significant period. This is the period of the dot-com bubble. You can see that the index crashed. I'm trying to make a point here. If you look at the 2007, 2008, the index had some rough time as well. And after that time, the index mashed up aggressively, and here was when we had COVID around this time. The index crashed, but it picked up again, and we had the Russian Ukraine invasion. The index came down. After that, the index picked up again. So you could actually see that even when there are ups and downs for you as an investor, investing in an index or an ETF that tracks this index is one of the best investment decisions that you'll have made, at least in the last 5 years. Because in the last 5 years, this index has done an average of about 140%, which means if you had invested maybe an average of about £1,000 or $1,000, whichever country you live in, this index will have given you about 140% of what you've actually put in into that ETF that tracks the index or the index itself. So that's exactly what it looks like. So now, what is the downside of this index? The downside of this index is that it's highly reactive. It's very temperamental to major headlines that affect the big tech companies. Look at what we had during the DeepSeek AI breakthrough, if you may, where they said you don't need too much of the GPUs to actually do all the large language models that makes ChatGPT. We had that drop, and if you see year to date, the index is now down by about 4.2%. So the index is very reactionary, very reactive, very temperamental to the big headlines. We've also had the tariff war started by President Trump against Mexico, Canada, China, and almost every other country. Even the negotiation about what is going on in Ukraine and a whole lot of the other global headlines, especially US specific headlines, that is actually affecting or increasing the level of uncertainty and mitigating or reducing the kind of risk appetite that investors actually have in the market. So if you are an investor that you are not too comfortable to actually see the returns or your capital go down in value in the short and medium term, this index or the ETF that tracks index might not necessarily be for you. Of course, you still have to do your due diligence, consult your financial advisor, but this is the downside of the index. If you see in the last 1 month, it's been down by about 5.7%. In the last 5 days, it actually went aggressively low. Like the last 5 days has been the worst, at least in the last couple of months or years, a few years down the line, at least close to about 3.6%. Now, what is the silver lining? The silver lining is that the good news, which is not just a silver lining, is that if you are just an investor that is just getting to start your journey into the financial markets, this is the best time to actually invest in this index or an ETF that tracks the Nasdaq ETF, the Nasdaq Index 100 index. So, for instance, when yesterday I actually made the decision to actually buy the Nasdaq 100 index for the first time. I didn't have exposure to it directly. I had the S&P 500 index, but now with the fact that this index was able to pull back aggressively, close to about 4 to 6% in the last 2 to 3 months that we started this year, that is a very good entry point for me, because I know with all of this uncertainty, if all of this uncertainty is resolved, the tariff and everything, because that is actually how the market works. So there will be a whole lot of negative news. We call it FOD in the financial forums and community, which is fear, uncertainty, and doubt. FOD, FUD. So there will be a lot of FOD here and there, and a whole lot of negativity permeates the market. You see a whole lot of this kind of index that are very reactionary. They tank, and that's the best time to buy this index, because when the market picks up, this index is likely, and in most cases actually outperforms the typical S&P 500 or the typical dividend related ETFs or index. So that's basically what the Nasdaq 100 index is all about. If you're an investor that you want to take in a bit more risk or a bit more volatility, and you are ready to actually wait within 1, 2, 3, or 4, 5 years, this is one of the best index you can have exposure to, because the kind of return this index has given, if I go back to the all-time chart, is phenomenal. 16,000% since 1985. You might actually think 1985 is a long time, but even if it's just 5 years down the line that you've invested in this index, you have 140% guaranteed, even when the index has had ups and downs in the last 5 years. COVID, the lockdowns, the Ukraine invasion, a whole lot of things has actually, and this index still managed to do 140%. So thank you so much for watching. Thank you for joining us. Thank you for subscribing to our channel. Please follow us. Join our community on X. We bring you all the breaking news at Stocker Team Live, on X. On Monday, we get to actually see, because the market is now pricing in all of this uncertainty. The market is a bit getting used to a whole lot of the different news, discordant tunes from the Trump administration. Oh, the tariff is coming today, it's not coming tomorrow. They are starting today, they are not starting tomorrow. So that's why, as an investor, you need to actually, separate the noise from the fact. Nothing has really changed about the companies that are actually in the market. A whole lot of these companies are even doing better than they were doing in the last 3 years, when inflation was very high. Now that inflation is not as very strong as before, many of these companies are in a better position, especially the ones that have the moat, they have the competitive edge, they have better balance sheet, they have better financials, and they are actually investing in their business, especially in the tech ecosystem, where you see a whole lot of companies differentiating themselves in the AI play. So that's why the Nasdaq 100 index might actually be the best time, because a whole lot of things has cooled down. A whole lot of repricing has now coming into some of these stocks. So it might be the best time to think about this index. What do you think? Let me hear from you. Till Monday when we meet. Keep investing, keep growing. Take care, and bye bye.